Good morning, everyone. This is Corey Hinkle, and I'll be your host for the Ankerstar Wealth Daily Update. Today, we're going to talk about a few important things going on in the market. So, a market update, something out there called panic selling that we're seeing not only anecdotal data, but also quantitative data on. And then we're going to talk about what a stock market correction is and kind of my opinions around that and what we're seeing. So before I get started, I want to remind everyone that this is a financial education presentation. You must do your own due diligence before acting on anything you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and mine alone. All right, I'm going to share something with you, and we're going to start breaking down everything from a market update on into those other topics. Okay, first, starting about February 20th, we've seen a pretty quick, actually a very quick correction forming in the S&P 500. A correction would be a fall between 10 to 20%. We tapped a 10% fall on Tuesday, and then we've kind of been hovering just above that now. That's kind of the first thing we've been seeing. And if you're like any of us, you've noticed it in your portfolio as well. One thing that's kind of interesting about this correction, and I don't have the for sure data on if they counted us tapping a 10% correction on Tuesday as a correction, if whether or not they counting that. But if it did count, it would actually be a top 5 fastest S&P 500 correction in the past 75 years. Fast. This is a very fast move down in the S&P 500. And that's noticeable, right? Now there's something that's, although this is fast, there's also something else very unnatural going on around sentiment. So AAII investor sentiment surveys are done all the time, and they track investor sentiment about their feelings towards the next 6 months and the returns expected over the next 6 months in the stock market. Sentiment flashed into extreme bearish territory, so extreme negative territory, towards the end of February. As many as 60+% of investors were feeling negative about the S&P or the market's potential returns over the next 6 months. What's really interesting and odd about this is that we typically see this at the very end of deep market drama or crashes, even, or drawdowns. So we saw this at the end of the great financial crisis. We saw this at the end of the COVID lows, and we saw this in October of 2022 when the market was bottoming. And here, the reading actually started flashing extreme negativity when the market was only down 4 to 5% from its all-time highs. This is something very rare, very unique and unnatural. So why is that? And you can ask yourself that same question. Has your sentiment felt a little bit more negative than you would have expected, given what hasn't been an extreme bout of volatility? Here's what people are saying. So this is a post that went viral. Someone said, I broke the #1 rule. I panic sold. Been investing for 3 to 4 years now, mostly in VU, that's an S&P 500 index fund, and NVIDIA, with a sprinkle of Bitcoin. Never cared about red days or green days, didn't bother following the market, news, or politics. But they say this, the algorithm is annihilating me. Everywhere I look online is Trump this or Elon that, tariffs this, tariffs that. And they got really scared. So they're saying that America is alienating itself from its longtime allies. That's something we'll talk about later in the show, this idea of isolationism. And if I believe that's something that's going to impact America for the long term moving forward. This is what's going on. Here's another one. JC Peretz, my favorite technical analyst and just a very loud voice in the investing community. He said, my mom has never once called me about the stock market ever in my life. I've been at this professionally for more than 2 decades. She called me today telling me she saw on Instagram and LinkedIn that we're going into a recession because of Trump and she wants to liquidate her IRA. Here's another example of someone who has never before panic sold and now they're wanting to panic sell. Panic selling is someone who is making an abrupt, impulsive, and lasting decision about selling high quality assets over some short term fear that has settled into them. And panic selling, I want to make sure you know, I want to be very clear about this. It is not a strategy. It's not an investing strategy. And it's not a good investing strategy if someone is using it as a strategy. We don't want to react to feelings of panic or other people panicking. I will say there is a scenario where if someone has a very like a thin ice around their job, their employment, and their portfolio is likely to be something they are using for everyday expenses, um, and they were heavily invested in stocks in that scenario, that's an individual who might have been over allocated to stocks and might need to reevaluate their entire situation. But that's based on that person's situation. The idea of panic selling because someone is scared of a tariff or something else is not a good investing strategy. We want to be fundamental investors and we want to own high quality assets for long periods of time. Here's the other one. Here's the data. 401k investors are trading the most they have in 4+ years in pursuit of safety. They mention in this article that 401k investors are cramming as much as 2 months worth of trading volume into a week at a time. So these people are rushing to what they believe as safety as they are, I guess, in theory, scared about something going on in the market. So panic selling. We're seeing that everywhere. I do want to be clear that if you are feeling any of those feelings, please call us and reach out to us. We have processes in place, and we also own as high a quality assets as we can identify in the world. So we have all those safeguards in our models, for our clients. And if you're feeling something you want to talk to us, please do that. I believe we're in a stock market correction. We get these about about once a year. What do those look like? They can look like this. So this chart averages all market corrections over the past since World War II. A market correction, again, is a 10 to 20% decline in the S&P 500. If you average all of them together, the market typically falls about 14.1% in a stock market correction. Again, this is normal market activity. If you watched our dollar cost averaging video the other day, you know that these opportunities allow us to supercharge our returns for the next move higher in the market. So these can be very beneficial to us. Of course, at some point we have to buy stocks, right? And if we get to do that at a more attractive price, it lets our dollars work a little harder than they otherwise would have. Okay, so about a 14% drawdown. This can take, about 5 months to do that. So if we peaked in February, midsummer-ish, somewhere around there, and then it takes about 4 months to recover. So that would put us, somewhere towards the end of the year, possibly approaching new all-time highs. That gives us 9 months to take advantage of possibly a little bit better deals or lower prices in the market. Again, my theory, my belief is we're in a normal stock market correction, and this chart shows us what a normal stock market correction is. Let's go back to that isolationism. So people are concerned that some of these political policies that have been teased out there or are being implemented out there are going to isolate America from the rest of the world, and that's going to be really detrimental to our economy. One quote I heard from someone was that we might all go bankrupt was someone's fear. I was wondering what percentage of Canada and Mexico's GDP is tied to trade with the United States. So in Canada, about 20% of their GDP is tied to trade with the United States. Mexico, around 30% of their GDP is tied to the United States. Going back to my belief, it's my belief that there is a symbiotic relationship that's been established between these countries in this part of the world and frankly all around the world, and that there is no real future where those trade ties are undone. Um, that's not good for Canada. That's not good for Mexico, and it's not good for the United States. These countries, to follow through with truly isolating the United States, would have to, it'd be an eye for an eye. They'd be taking out their own eye in order to do that. And at some level, it just wouldn't be worth it. The incentive is for these countries to negotiate and move forward with those trades, those trade ties in place. So my belief, I don't think that isolationism is an existential threat to the United States economy. That's my opinion. Part of the reason I do want to hit on this, stock market valuations had been a bit high going into 2025. You can see not as high as the tech bubble, of course, also not as high as the 2021 peak, and also we're 10% off of this now. That 10% off is not reflected. So we've really moderated quite a bit with those stock market valuations. Those high valuations were somewhat of a reflection that blue skies were ahead. There was no fear priced into the market. There were no worries priced into the market. As a matter of fact, leading into the inauguration, there was quite a bit of exuberance and enthusiasm priced into the market, much more so than fear. Having some fear, so now we've got some clouds in the sky, right? Having some clouds back in the sky, having some of that priced in, it gives us opportunity. And it's also important to recognize that the clouds that appear to be in the sky right now, the investing sky, right? It's a cloudy day. If you go and look stock by stock, things aren't bright and sunny like they were. It's important to recognize that this is like a man-made storm overhead, and the clouds were put in place quickly, right? And they can be removed quickly if that becomes necessary. And I believe that at some point they likely will be removed quickly. What causes crashes? Some people have said we're going to stock market crash, stock market crash. You listening to this might have wondered yourself, is the stock market going to crash? There's usually three things that cause a stock market crash. Three kind of main things that we've seen in the past, 75 years or so. One would be inflation. And if inflation gets way out of control, the Federal Reserve has to dramatically reduce demand out there, and they do that by increasing rates quickly, making it very hard for economic activity to take place, making it very hard to invest, for capital formation to take place, and all those things. So they really, cut down on demand out there, and in doing so, they slow down economic activity, and the stock market gets punished heavily for that. Another one we've seen was around the year 2000, the tech bubble. So huge bubbles can pop. Are we in a huge bubble right now? I'll spare you the time. We could go stock by stock through the Mag 7 or even beyond that in the market. We are not in a huge bubble. Things are still not dirt cheap, but things being a little pricey is different from a bubble, and we're not in a bubble. And the last one is kind of that traditional nightmare scenario where you get earnings are declining for companies, and because of that, they hire less people, so employment declines, and then consumer demand declines because less people have jobs, which makes earnings decline further. It's that downward spiral, and then employment declines further, and then demand declines further, and then earnings decline further. And I'll stop there. But that downward spiral, we're not seeing a downward spiral of demand and earnings and employment right now. That's not impossible they could change. We just aren't seeing that right now. The ingredients for a stock market crash are not out there right now. I do want to end by just saying that we have processes in place for, my predictions not being the reality that plays out ahead of us. There are things in place if that weakness extends beyond my expectations. Please reach out to me, reach out to your advisor if you have any questions about that. Otherwise, our current perspective is that we are in the midst of a normal stock market correction, which would be, if it gets to that 14%, maybe about 4% or so more to go to the downside from here. That's all I have for you today. Have a great day, and we'll see you soon.